On February 8, 2026, just after North American markets opened, something happened that never appeared as a breaking alert, but instantly changed the financial relationship between two countries. There was no emergency press conference, no dramatic announcement, no warning headline flashing across your screen. Yet, behind the scenes, money stopped moving the way it always had. What I'm about to show you is not being reported as a crisis, and that's exactly why it's dangerous. Within hours, Canadian banks began facing something they are structurally unprepared for: restricted access to US dollar liquidity, not frozen in the dramatic sense people imagine, not seized, just slowed, scrutinized, and quietly choked at critical junctions of the system. And when money slows in a system built on speed, stress appears immediately. Most people assume financial crises start with panic. They don't, they start with silence. While headlines focused on routine market volatility, banks were already adjusting internal risk models. Funding desks were recalculating exposure. Currency traders were repricing confidence. And none of it was meant for public consumption. This wasn't about stocks dropping. This wasn't about a single bank failing. This was about access. Who controls it, who depends on it, and who can shut it off without calling it a shutdown. Here's the part that should make you pause. Canada's banking system is stable by design, but it is not independent by structure. It relies heavily on US dollar funding channels to support trade, credit, and cross-border settlement. When those channels become constrained, even slightly, the system doesn't break immediately, it tightens. And tightening is far more dangerous than collapse, because it happens quietly, unevenly, and long before the public realizes anything has changed. What you're seeing now is not a policy dispute. It's not a diplomatic argument. It's financial leverage being applied with surgical precision. And no, this isn't about punishment. It's about control. The mechanism being used doesn't require Congress. It doesn't require sanctions. It doesn't even require a formal declaration. It operates through regulatory discretion, compliance thresholds, and enhanced scrutiny, the kind that slows capital without ever saying the word block. That's why markets reacted before politicians did. Because markets understand something governments rarely admit out loud. If you control the flow of dollars, you control the system. Banks felt it first. Currency markets followed. And by the time the public hears an explanation, positioning has already changed. Now here's where most coverage gets it wrong. This wasn't designed to scare Canadians. It was designed to reprice risk, quietly, efficiently, and without triggering immediate backlash. And once risk is repriced, everything downstream changes. Lending standards, credit availability, investment flows, even political behavior. Not overnight, but fast enough that by the time confidence returns, the rules are already different. This is why focusing on surface headlines is dangerous. The real story isn't what was announced. It's what stopped moving the way it used to. And this is just the opening move, because when capital roots tighten, the effects don't stay inside bank balance sheets. They travel straight into currencies, housing, pensions, savings, and purchasing power. You don't need to be a trader to feel this. You don't need to hold Canadian bank stocks. You just need to live in a system that depends on money flowing freely. And right now, that flow is being tested. But before you can understand where this leads and who ultimately pays the price, you need to understand why this matters directly to you. And that's where we go next. At first glance, this feels distant, a banking issue, a policy issue, something for economists, analysts, or politicians to argue over. But the truth is far less abstract. When dollar access tightens, even quietly, the first thing at risk isn't markets, it's certainty. And certainty is what your savings, retirement plans, and long-term financial security are built on. Here's why this matters to you specifically. Modern banking doesn't operate on stored money. It operates on continuous flow. Deposits are transformed into loans. Loans are bundled into assets. Assets are funded through short-term liquidity channels, many of them denominated in US dollars. When those channels become restricted, banks don't fail immediately. They pull back. Credit becomes selective. Risk tolerance drops. And the cost of money quietly rises. You don't see this on the news right away. You feel it when approvals take longer, when rates don't come down as expected, when access becomes conditional instead of assumed. This is how stress reaches households without ever announcing itself. Now layer in the bigger picture. Canada's economy is deeply integrated with the US system, not just through trade, but through funding, settlement, and currency dependence. That integration works beautifully when conditions are stable. But when pressure appears, it creates an imbalance, because one side controls the currency everyone needs. This isn't theoretical. We've seen it before. In past financial stress events, from global liquidity freezes to regional banking shocks, countries that depended on external dollar access always faced the same sequence: tightening credit, weakening currency confidence, and rising cost of living. Not because demand suddenly surged, but because money became harder to move. And when money slows, prices don't fall evenly. Essentials react first: food, energy, housing costs, debt servicing. This is where the threat becomes personal. If you rely on fixed income, pensions, or long-term savings, volatility isn't just uncomfortable, it's destructive. Because your financial planning assumes stability in the system providing those returns. But stability doesn't disappear all at once. It erodes. And erosion is harder to spot than collapse. Here's the uncomfortable part most coverage avoids. Retail participants absorb risk after institutions have already adjusted. Banks reprice lending before consumers feel inflation. Corporations hedge currency exposure before wages adjust. Governments speak confidently while balance sheets quietly deteriorate. By the time the narrative changes, positioning is already locked in. This is why the phrase, "they've been planning this," keeps surfacing. Not because of a secret meeting, but because systems are designed to protect themselves first. The conflict here isn't ideological, it's structural. Banks versus depositors, liquidity providers versus liquidity users, institutions with optionality versus households without it. And that divide widens fastest during periods of quiet stress. Now add the geopolitical layer. When financial pressure intersects with policy objectives, economics becomes leverage, access becomes influence, and influence reshapes behavior, not through force, but through necessity. That's when financial decisions start carrying political consequences, and history shows us exactly where this road leads. In previous cycles, when similar conditions appeared, the public was told everything was under control, right up until measures were introduced temporarily to stabilize markets, measures that lasted far longer than promised. That's not fear-mongering. That's precedent. So if you're asking why this matters now, the answer is simple. Because systems under quiet stress don't announce turning points. They reveal them through behavior, and behavior has already changed. Banks are more cautious, capital is more selective, and confidence is being repriced behind closed doors. Which brings us to the next question, the one that actually determines how this unfolds. Who benefits when pressure builds slowly instead of breaking fast? Because understanding that tells you everything about what happens next, and that's where we need to go now. To understand what's really happening, we need to stop thinking in headlines and start thinking in balance sheets. Because this story doesn't revolve around panic, it revolves around control. At the center of that control sits a small group of institutions that don't just participate in the financial system, they are the system. Among them, one name consistently appears whenever stress surfaces across currencies, commodities, or cross-border liquidity: JP Morgan. Not as a villain in the cinematic sense, but as a structural force. A bank so embedded in global finance that its actions don't need to be announced to shape outcomes. Here's why that matters. JP Morgan isn't just a lender, it's a primary dealer, a derivatives clearing giant, a counterparty to governments, central banks, corporations, and exchanges. When volatility rises, JP Morgan doesn't react like the public does, it repositions. And repositioning doesn't look dramatic, it looks quiet. Exposure is shifted, risk is transferred, liquidity is preserved. This is where misunderstanding often happens. When reports surface about banks reducing exposure or exiting positions, many assume it's defensive, even fearful. But large institutions don't move to avoid losses the way individuals do. They move to optimize leverage and protect optionality. Losses can be managed. Illiquidity cannot. That distinction explains almost everything. JP Morgan has faced scrutiny before: congressional hearings, regulatory reviews, settlements related to market practices, not because it operates outside the system, but because it operates at its core. When you sit at the center, every adjustment ripples outward, and those ripples don't hit everyone equally. Retail participants feel outcomes, institutions manage causes. This is where motivation becomes clear. Banks like JP Morgan don't need markets to go up or down. They need markets to resolve. Resolution clears weak positioning. Resolution removes fragile leverage. Resolution restores pricing power to those who can stay solvent longest. Volatility isn't a threat to that model. Uncertainty is. That's why periods of controlled stress are often preferable to prolonged instability. A sharp adjustment resets conditions faster than a slow bleed, and faster resets favor institutions that can absorb short-term damage. This isn't conspiracy, it's mechanics. Now consider regulation. Large banks operate within frameworks that smaller players don't have access to: internal netting, collateral flexibility, regulatory forbearance, and direct channels to central liquidity. These aren't loopholes in the dramatic sense. They're structural advantages baked into the system. When pressure builds, those advantages matter. Positions that would trigger forced liquidation for a hedge fund or retail trader can be rolled, restructured, or offset within a large bank's internal ecosystem. That asymmetry defines who survives volatility and who doesn't. So when stress appears across borders or currencies, it's not chaos, it's sorting. Risk moves upward, losses concentrate downward. And the system calls that efficiency, This is why JP Morgan's presence in moments of financial stress is always worth examining, not because it caused the situation, but because its behavior tells you where the pressure is migrating. When exposure is reduced quietly, it signals anticipation, not panic. And when anticipation appears at the top, it usually means pressure is about to surface elsewhere. That's the real warning signal. But to understand why this keeps happening, why the same institutions remain protected while others absorb the fallout, we need to step back. Because this pattern didn't start here. It didn't start recently, and it didn't start accidentally. To see the full picture, we need to go back to the moments when this structure first revealed itself. And that's where history becomes impossible to ignore. To understand what's happening now, you have to stop treating this as a modern crisis. Because the structure we're watching today has revealed itself before, repeatedly. Whenever financial systems are pushed to their limits, history doesn't repeat itself exactly, but it exposes the same weaknesses every time. Let's go back. In moments of extreme stress, markets don't collapse evenly. They fracture along lines of leverage, liquidity, and power. The players who depend on borrowed confidence break first. The players who control balance sheet flexibility endure. This pattern was unmistakable during the global financial crisis. In 2008, the failure wasn't about housing alone. It was about leverage stacked on top of leverage, hidden behind complexity. When liquidity froze, prices didn't fall because assets were suddenly worthless. They fell because positions had to be unwound immediately. Forced selling drove prices far below fundamental value. Sound familiar? The same thing happened decades earlier during the silver market breakdown tied to concentrated speculation. Prices didn't collapse because demand vanished. They collapsed because margin requirements changed and leverage was withdrawn. Once forced selling ran its course, price behavior reversed violently. That wasn't recovery, that was repositioning. In each case, the narrative told to the public focused on surface-level explanations, panic, bubbles, irrational behavior. But underneath, the real driver was mechanical, leverage limits being enforced unevenly. Those who had access to liquidity survived, those who didn't were removed, and this structure wasn't accidental. Financial systems evolved to protect continuity, not fairness. Stability is preserved by sacrificing weaker nodes when stress appears. That's how risk is managed. This brings us to one of the most overlooked historical parallels, moments when paper claims and real-world constraints diverged. During multiple crises, prices moved violently on screens, while physical markets told a different story. Supply didn't suddenly surge. Demand didn't disappear. Yet prices collapsed anyway because the paper system had reached its tolerance limit. When that happens, price stops being a signal of value and becomes a signal of stress. History shows that these breaks tend to follow the same sequence. Leverage builds quietly during rising confidence. Risk is normalized. Positions expand. Then something shifts. Policy, liquidity, credit conditions. Margin requirements rise. Funding tightens. Volatility accelerates. At that point, belief no longer matters. Only balance sheets do. That's when forced selling begins, and forced selling always overshoots. What comes after is the part most people misunderstand. Once weaker positions are flushed out, the system doesn't return to its previous state. It reorganizes, ownership changes, exposure consolidates, and pricing power shifts upward toward institutions that were able to wait. This is why rebounds after violent sell-offs feel unnatural. They arrive before confidence returns, they confuse observers, they're often dismissed as dead cat bounces. But history tells a different story. Those moves mark control transfer, not recovery. Another critical historical lesson is timing. The most important structural shifts are never obvious in real time. They only make sense after the fact. During the event, everything feels chaotic. Narratives conflict. Experts disagree. Headlines lag reality. But the data beneath the surface already knows what's happening, and that data always points to the same conclusion. When volatility remains elevated after a reset, the system hasn't healed. It's still adjusting. This is where the present aligns perfectly with the past. Persistent volatility, thin liquidity, conflicting signals between paper markets and real-world behavior. Those are not signs of resolution, they're signs of transition. History also teaches us something uncomfortable. Every major financial disruption was described at the time as unprecedented. In reality, the structure behind it was familiar. What changed was scale, more leverage, more interconnectedness, less margin for error. That makes modern systems faster and more fragile. Which brings us to the unavoidable conclusion. If this were just a temporary disturbance, the system would already be calming, liquidity would normalize, volatility would fade, Confidence would rebuild smoothly. That's not what history suggests happens at this stage. History suggests that once a system reveals its fragility, it rarely hides it again quickly. And that means the most important evidence isn't theoretical, it's empirical. It's sitting in positioning data, funding behavior, inventory signals, and institutional actions that don't make headlines. That's where the real story is now. And in the next chapter, we're going to look directly at that evidence and the numbers, the flows, and the contradictions that expose what's really happening beneath the surface. Because once you see the data clearly, it becomes impossible to believe this phase is over. If this was just panic, the data would already be calming down. That's the first thing you need to understand. Markets recover from fear quickly. Liquidity returns. Volatility compresses. Stress indicators normalize. When that doesn't happen, when the numbers stay tense even after price rebounds, it tells you something structural is still unresolved. And that's exactly what the data is showing. Let's start with positioning. During the sharp sell-off, a significant amount of open interest disappeared from the market. That's not a sign of long-term investors changing their minds. It's a sign of forced liquidation. Positions were closed not because conviction vanished, but because margin tolerance was exceeded. That distinction matters. When prices fall and open interest collapses at the same time, it signals mechanical selling. Leverage was removed abruptly. This is the fingerprint of stress, not sentiment. Now here's the first contradiction. If selling was driven by collapsing demand, physical availability would increase. Premiums would fall, delivery timelines would shorten, inventories would swell. That didn't happen. Instead, physical markets remained tight. Dealer availability didn't suddenly improve. Delivery friction persisted. That tells us the sell-off wasn't driven by people abandoning the asset. It was driven by paper exposure being unwound. This is where paper and physical diverge. Paper markets reprice instantly because contracts can be closed with a click. Physical markets move slowly because metal has to change hands. When paper collapses while physical conditions remain constrained, the disconnect doesn't resolve quietly. One side eventually adjusts. Now look at inventories. In true bear phases, inventories rise as material flows back into the system. Supply loosens. Pressure fades. But inventory behavior hasn't reflected a broad release of metal. Instead, stocks have remained tight enough to keep delivery stress visible. That's not confirmation of collapse. That's confirmation of imbalance. Then there's future structure. During calm conditions, markets trade in contango. Future delivery costs more than immediate delivery. But when backwardation appears even briefly, it suggests immediate availability carries a premium. That doesn't happen when demand disappears. It happens when access matters. Backwardation during volatility isn't a curiosity. It's a warning sign. Now combine that with institutional behavior. When large institutions report pressure tied to derivatives exposure, it doesn't mean they're failing. It means volatility has crossed a threshold high enough to show up on even the strongest balance sheets. That usually happens at the same time smaller participants are being forced out. This is how risk transfers. Losses surface at the top, liquidations happen at the bottom, and in between, exposure quietly changes hands. Here's the part most people miss. These moments don't eliminate risk, they concentrate it. Once leverage is flushed, markets become thinner. With fewer positions cushioning price action, smaller flows create larger moves. That's why rebounds after liquidation feel unstable. They don't restore calm, they increase sensitivity. Another contradiction sits in global demand. Outside Western paper markets, demand tied to industry hasn't disappeared. Energy transition requirements don't pause because futures markets liquidate. Manufacturing demand doesn't collapse overnight. Those forces operate on timelines far longer than a volatility spike. This is why global flows haven't aligned with the collapse narrative. Now step back and connect the dots. Forced liquidation visible in open interest, physical tightness persisting beneath paper volatility, inventory behavior inconsistent with demand collapse, structural stress signals appearing during the rebound, institutional exposure surfacing as leverage clears. Each data point alone raises questions. Together they form a pattern. This wasn't a failure of belief, it was a failure of leverage. And leverage failures don't end stories, they reset them. The danger isn't that price moved violently. The danger is that the system required violence to restore balance. That tells you fragility remains. After resets like this, markets don't become safer. They become sharper. Price becomes more reactive. Sentiment lags reality. Confidence returns before stability does. That's why waiting for confirmation is risky. By the time consensus forms, the market has already adapted to a new structure. And that brings us to the most important question. If leverage has been reduced, exposure has shifted, and sensitivity has increased, what happens next? Because history and data agree on one thing. This phase doesn't end quietly. It transitions. And in the final chapter, we're going to map out exactly how those transitions usually unfold, the scenarios, the triggers, and what actually matters watching from the outside. Not predictions, preparation, If you miss just 3 signals in the next phase, a policy shift, a liquidity move, and one institutional action, you won't realize the rules changed until after the damage is done. That's the reality of post-reset markets. When leverage has already been flushed, markets don't wait for big headlines. They move on imbalance alone. And right now, imbalance is exactly what defines this environment. Here's the roadmap. Not a prediction, but a risk map. After events like this, markets typically enter a transition window, not resolution, transition. This is the period where positioning is thinner, reactions are sharper, and confidence returns faster than stability. There are 2 broad paths forward. The first scenario looks calm on the surface. Liquidity improves marginally, volatility compresses, price moves sideways or recovers slowly. Commentators declare the danger over. Confidence rebuilds. This outcome feels reassuring, especially to anyone who just survived the drawdown. But here's what rarely gets said. Stability does not mean protection. Even in this optimistic scenario, the system remains fragile. Buffers are thinner, leverage may be lower, but sensitivity is higher. Small shocks now carry more weight than large shocks did before the reset. For households, this means relief without safety. Savings feel secure again, until they aren't. Retirement accounts stabilize, but remain exposed to sudden repricing. Purchasing power doesn't collapse, but it doesn't recover either. The second scenario is less comfortable, and historically more common. In this path, physical and financial pressures fail to realign cleanly. Liquidity tightens again, even briefly. A policy decision, funding stress, or credit event acts as a trigger. And because positioning is thin, the reaction is outsized. This is where markets move fast. The public narrative stays calm. Official language emphasizes order, but institutional behavior tells a different story. Exposure is reduced quietly. Risk is shifted. Hedging activity increases. And by the time the move is obvious, it's already happened. This mismatch between messaging and behavior is critical. Markets don't break when everyone panics. They break when confidence returns too early. Across analysts, institutional observers, and long-term market participants, there's growing agreement on a few points. Risk isn't gone. Incentives remain misaligned. Retail participants receive signals last. The consensus isn't that everything collapses. It's that the margin for error has disappeared. And that brings us to the real question. Why now? Why did stress surface here? Why did leverage unwind this way? Why did the system require force to rebalance? The answer isn't a single event. It's timing. Pressure had been building quietly. Exposure accumulated. Liquidity relied on confidence holding. When that confidence cracked, even briefly, the structure underneath was exposed. That moment wasn't random. It was the signal. Not of an ending, but of a shift. So what can you actually do in an environment like this? First, shift from prediction to preparation. You don't need perfect timing. You need awareness. Build a simple weekly watch list. Track a few key indicators. Liquidity conditions, institutional behavior, and stress signals, not headlines. Second, practice risk hygiene. Avoid leverage traps. Maintain buffers. Understand that sharp moves now require less fuel than before. Volatility is no longer noise. It's information. Third, defend your information flow. Prioritize primary sources. Ignore narratives that explain price without explaining structure. Markets don't move to reward certainty. They move to test it. You're not powerless here. You're early. Because most people only realize a cycle has changed after it punishes them. You're seeing it while it's still forming. And if this video helped you see the market more clearly, like this video and subscribe to the channel, because this cycle isn't finished and the next moves will matter even more. In the next video, we'll break down the exact indicators institutions watch so you can track reality, not headlines. Stay sharp, stay informed, and stay ahead of the shift.